When you log into your 401k account, you're probably thinking, am I investing in the right mutual funds? Let's go over some of the most common 401k mutual funds so that you can decide what's best for you. And keep in mind that I'm not here to tell you what to invest, but to help you understand what these mutual funds do to grow your 401k. You have to be the one to make the 401k investment decision, not me, not your financial advisor, or not another YouTuber. This is the money that you have been working very hard to save for your retirement. So you should never blindly trust someone else to invest the money for you. But there are some 401k investments for beginners that you can start investing without doing much research because it'll do the work for you. So let me show you this. So the most common one you're gonna see in your 401k is probably the target date retirement fund. And I'm gonna go over the other mutual funds later on in this video. The target date retirement fund will look something like the Vanguard Target Retirement 2050 Fund, Schwab Target 2055 Fund, Fidelity Freedom Index 2060 Fund, or something like that. The name of the fund usually starts with the broker that manages it. So if it's owned by Vanguard, then it'll say Vanguard, right? What matters more is the year that you choose. For example, if you turn 60 years old during the year 2050, then the 2050 target date fund in your 401k will gradually reduce risk by reallocating money from stocks to bonds every year. The target date funds will show years in 5-year increments like 2040, 2045, 50, 55, and so on and so forth. When more younger people go into the workforce, they're going to open up more target date funds like 2070 or 2075 if they were born in 2010 or later. If you feel old, then you're definitely not alone. But anyway, if you were born in 1994, then you're going to be 60 years old in the year 2054. So generally speaking, the 2055 target date fund might be right for you based on your current age. Do you have to follow that? Not necessarily. Some people go further out to 2060 or 2065 because they want to have a target date fund with more stock allocation, or they don't expect to retire until 65 years old or later. So while it's important to choose the right year for your target date fund, it is also important to understand what's inside your target date fund, okay? So since most of my viewers responded to my survey that you use Fidelity for your investments, I'm gonna use the Fidelity Freedom Index 2055 target date fund as an example. I'm not sponsored by Fidelity, nor is anything I'm about to go over should be considered personalized financial advice. This is just for educational purposes only. If you have any further questions about your 401k, you can schedule your 60-minute session with me by visiting firechacha.com/coaching. But anyway, the left side of this, where it's gonna show you what this mutual fund is. It is a mutual fund managed by Fidelity with a target retirement date in the year 2055, okay? This mutual fund was created on June 1st, 2011. The gross and net expense ratio is 0.12%. What this means is that Fidelity is charging you $12 for every $10,000 you invest in this mutual fund. Warren Buffett, possibly the greatest investor of all time, once said that costs really matter in investments. He's absolutely right. You need to know how much of your money is going to the mutual fund every year. If this mutual fund performs a 7% return, then your net return after the expense ratio of 0.12% is going to be 6.88%. That makes sense so far, right? So pay attention to what you're paying for before you decide to invest in any 401k mutual fund. The next one is the net asset value, or NAV, okay, right here, where it says $20.82. I don't want to go too technical about this because that's not my intent here in this video, but it basically represents the value of this mutual fund by adding the total value of the fund's assets and subtracting its liabilities. Let me just tell you in the most basic ways. Mutual funds use NAV to calculate the price per share of the mutual fund. So if the NAV of this mutual fund says 20 bucks, if you purchase $1,000 of this mutual fund, then you're gonna get 50 shares because 50 shares multiplied by $20 is $1,000, right? And keep in mind that mutual funds allow you to purchase fractional shares. So if you purchase $910, then that's going to be 45.5 shares if the NAV is $20. And minimum to invest here is usually not applicable in your 401k unless they have a specific fund that only allows high or higher net worth individuals to invest in. They would have something like a minimum investment of 100,000 or even $1 million, and I've seen that with Vanguard. But anyway, in this case, the minimum to invest in this mutual fund is $0. The turnover rate in the mutual fund basically means the percentage of its stocks, bonds, or other holdings that were bought, sold, and changed in 1 year. If you see a turnover rate of 50%, then that means half of these mutual fund investments were sold in the previous 12 months, and that could be considered a high turnover ratio. If it says 10%, then that means 10% of this mutual fund was bought, sold, or exchanged in the previous 12 months. That makes sense so far, right? The team that manages this mutual fund is also known as the fund manager, who makes changes to the fund's holdings based on macroeconomic conditions, government regulations, or market volatility. An index fund typically has a lower turnover ratio because it just follows what the market is doing. But an actively managed mutual fund, or ETF, could have a higher turnover ratio because it's trying to book profits by having a higher return. And when you click on performance and risk, you're gonna see how this target date fund has performed in the past year, 3 years, 5 years, or even 10 years, and since inception. Remember, whatever the percentage says on this chart, that's the average annual return for the past year, the past 3 years, the past 5 years, or 10 years. So if it says 5% under 3 years, then this target date fund performed an average of 5% return every year. If it says 10% under 5 years, then it's performed an average of 10% return every single year. It's not 10% in 5 years, but 10% every year for the past 5 years. And you can also compare how this target date mutual fund performed with other benchmarks or indexes like the S&P 500 or other similar target date funds. And when you click on composition, this is where it shows the asset allocations, and it tells you how this mutual fund is allocated between stocks and bonds. It'll even give you a further breakdown inside the stocks, like 55% in US stocks and 35% in international stocks. It's pretty typical for a target date fund that is really far out in the future years, with 90% stocks and about 10% bonds. So when you invest in this mutual fund, you're automatically investing 90% in US and non-US stocks and 10% in bonds. These are all typically in index funds too. So 90% of stocks are in the US total stock market index fund, and the other 35%, as you can see here, is in the international index fund. The bonds are also invested in an index fund with a basket of corporate bonds, mortgage bonds, and other types of debt. So what do you think is better? Investing $500 a month, making 10% return, or investing $1,000 a month, making a 7% return on investment? You can't figure out how much you can invest without a budget. There's no way around it. I personally tested out the budgeting app called YNAB, and it's not just an app that can track your income and expenses, but it can even help you create a plan to pay down your student loans, car loans, personal loans, or credit cards a lot faster. So if you're ready to change your life by getting out of the paycheck to paycheck cycle, you can get a free trial without any credit card information by using the link in the description below. So is the target date fund good for any investors? I think it's good for people who are brand new to retirement investing and still trying to get a good grip on how the stock and bond markets work. And if you're the type of person who just wants to invest and forget, the target date fund might be the right option for you. But just make sure to choose the target date fund that is close to your desired retirement age. You should also keep in mind that the allocation of these funds will change every single year. By this time next year, the target date fund I just showed you might be going from 90% stocks and 10% bonds to maybe 88% stocks and 12% bonds. It's also known as the annual risk reallocation. The target date fund will become even more risk averse every year. However, let me go back to that target date fund right here. The downside of the target date fund is that it has grossly underperformed the S&P 500 because the international stocks and bond allocation, okay? If you're someone who wants to be exposed to more risks by investing 100% in stocks, then the target date fund may not be the right option for you. Again, this is not in any form of personalized financial advice. The other mistake I often see is that people investing 2 or 3 different target date funds in the same 401k. Remember, target date funds are designed to be a single investment. It doesn't make sense if you invest in multiple target date funds like 2045, 2050, and 2055 in the same portfolio. Just pick one target date fund that is closest to your retirement age. That's just my opinion. If you want to be more aggressive, then you can pick a date that is further out from your retirement date. 2060 target date funds are more aggressive than 2055, and 2055 is more aggressive than 2050, and so on and so forth. Because the younger you are, the more aggressive you want to be with the stock bond allocation, right? So you've probably heard of the rule of 100, okay? So the rule of 100, if you talk to any financial professionals, which calculates what percentage of your portfolio should consist of stocks. For example, I'm gonna be 38 years old this year. The rule of 100 will be 100 minus 38, and that's gonna give me 62. So what that means is that it is 62% stocks and 38% bonds. So if I invest 62% of my 401k into something like the S&P 500 index fund and 38% of my 401k into the short-term bond index fund, then I'm really just exposing 62% of my portfolio to growth and 38% of it just beating inflation, maybe more, maybe less, depending on the inflation rate, right? But because most people are living a lot longer now than they used to 20 or 30 years ago, a lot more experts suggest that the rule of 120 might be more suitable to calculate the generalized stock bond allocation. So 120 in the same example here minus 38 would give me 82% stocks or 18% bonds. 82% would give you more risk exposure than 62% to stocks, right? You could use these numbers to match with the target date funds if you want to, but this is just the rule of 120. It doesn't mean that you have to necessarily follow this, but it just kind of give you the guidance on where you should be. But I have been historically investing 100% in stocks because I want to be exposed to risks a lot more. But you should really consider your overall risk tolerance, investment goals, and time horizon. If I am someone close to my retirement age and I need to rely on my 401k to pay for my retirement expenses, then I should consider reallocating some of my money to preserve capital or move it to income-based mutual funds. If losing 20% of your portfolio in a stock market crash would hurt your retirement income, then you should consider how much of your portfolio is exposed to a potential market correction, crash, or long-term bear market like from 2007 and 2009. But that's if you're close to your retirement age, right? And most of you starting out your FIRE journey are in what's called the accumulation phase. You're working on growing your 401k so that you can achieve your first 100,000, 250,000, 500,000, and then $1 million. If you're more risk tolerant, then consider increasing your stock allocation or investing in stock only mutual funds so that you have a higher potential return instead of using the target date fund.